Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. Today, thankfully, we've got Shubham on, and I really wanted to ask him some questions. I am an oil guy at heart. I went through the last cycle. I was watching natural gas and oil for the majority of it, so I like having the oil guys come on and give their opinions. So thanks for coming on, Shubham. I really appreciate it. So
Yeah, it's good to be back. Thanks for having me.
yep. So what are some things that you're kind of hyper focused on right now in the oil markets? What are you looking at? What are you seeing? What's kind of your overall outlook right now?
Yeah, great question. I think the big factor right now to watch is China. The China reopening. I know we've been talking about it for a while. There's been ebbs and flows, stops and starts, but for the first time in a long time, we're seeing them let COVID run rampant. You're hearing anecdotally things. You're hearing things out of the officials and some of the politicians that look, it's just a flu. They're putting out videos saying that you should be taking your mask off. Like, it's really bizarre how quickly they've turned on this, especially to do it from a political standpoint and make these broad statements. So watching for that to slowly add in. I think Goldman Sachs put out this thing, I want to say a couple of days ago, where they say Chinese reopening is going to add 1 million barrels of demand. Like, it's going to be way higher than 1 million barrels of demand. The 1 million barrels could be in just jet fuel itself within the North and Southeast Asian complex, and then the Chinese demand on top of that, internally and with the tourism that the Chinese tourists bring. So that's really top of mind. We're still following the Russian barrels and seeing what happens there with the exports on them, and then shale. Obviously, we're going to see where shale ends up here at the end of the year. Especially as the EIA 914 comes out a couple months down the road, and then set up for see what people are estimating for 2023. Because if they're estimating 1 million barrels per day again, they're going to not be happy with where shale ends up at the end of 2023. So kind of the three big factors there, and then demand. Obviously, I think overall global demand is not really being well understood. It's continuously running above what people were projecting. So watching for that to accelerate now as time goes on. And a little caveat to that is that when oil prices are high after a long time, some of the GDPs of these oil producing countries can go up like 7, 8, 10, 15% for multiple years in a row. And GDP only goes up when energy consumption goes up. So watch for that with some of these countries that have been suffering from a lack of internal revenue for quite a few years here.
Yeah, I was just thinking about this. I know you've got China, you've got America here. How much of an impact do you think the Strategic Petroleum Reserve releases have had to the price of oil? And do you think, I mean, I was just listening to you talk about China and their like quick pivot on lockdowns to like take off your mask, let's get going. Do you think there's any political thing going on here as well? Because it seems like we released and flooded the SPR to some degree to hold prices down, and now China maybe is trying to kick it all back on the demand and pump oil prices higher for their buddies over in Russia or something like that. I'm just guessing. I don't know. Yeah. What's your opinion on the SPR? And
yeah,
did that
100% a very dynamic situation. I think there's a lot of theories floating around that China's trying to help Russia, or they're helping OPEC, and at the same time China's trying to fight this proxy war or whatnot. And there's really no clear answer as to what's happening. I mean, it's really strange timing for the Chinese reopening to happen in this level when we have so many other factors like the SPR running out, as you mentioned. The Russian barrels are sort of at risk now. So the supply really isn't there to match this demand. And yeah, China's got a bit of a product cushion that they've built up. But I mean, when you're running at a 3 million barrel per day possible gain in demand, your inventories are going to run out so fast that it really doesn't even matter. So I think the SPR has done a really good job this year. I'm not going to deny that in terms of bringing prices down, controlling everything June, July, August onwards. But the bullet is being fired. So they really only had the one bullet. There's about another 25, 30 million that's probably going to come out next year. just with the mandated sales. And some people are saying that the administration can drain another 100 or 200 million in 2024. I really don't think so. I don't think they're going to bring it below 300 million. It really is a strategic problem. It's a national security problem at that point. So as a long-term oil investor, I'm very happy because we're constantly looking for things that can get the thesis off, cause a problem in the structural oil and gas bullish outlook. And one of the things is excess inventory all over the place. And looking around the world now, there really is no excess inventory sitting around doing nothing. You look at floating storage, you look at Fujairah, you look at Saudi, maybe look at even Singapore and China, Europe, the ARA area. We look at the US, we look at Canada. There's no excess like inventory floating around anywhere. So to me, that's a really good sign because it just makes me more confident in my investments. And look, if I'm going to make the investments, that's one less thing I have to worry about, because it was quite successful in 2022. The SPR did its job. The problem for the world and the US administration is that it was a one-time insurance policy. So they've now paid the deductible, they've used the policy, and they're no longer insured. So we go into this 2023 very open-ended and without a lot of safety nets. If either supply drops or demand picks up, there's no real safety net there, other than maybe some of the OPEC spare capacity, which itself is under question at this point.
Now, here's another question, and I think a lot of people get this backwards, and maybe I have it backwards, so maybe that's why I wanted to ask it. The SPR releases is actually bullish for oil. Is that a fair statement? Would you say it's bullish or bearish? Bearish in the short term, but actually more bullish because it held the price down and these high cost producers can't kick on. Is that a fair statement?
Yeah, 100%. And I think some of the bullishness gets a bit convoluted because people start talking about buying the barrels back and whatnot. It doesn't even matter. They don't even have to buy the barrels back for this thing to be bullish, because there's sort of a couple of factors. One, as I mentioned, the insurance policy is gone. So it allows us that if we do end up in a higher price environment in the near future, I mean, you can just release more again. So now we're going to sustain this higher price environment. And secondly, you rightfully like hit the nail on the head. Just when supply could have actually kicked on and people could have pivoted off the fence and said, oh, look, oil prices are, hanging in for $90, $100 plus for 6 months. Let's go and drill some wells. Nope, hang on a sec. We're back in 70s here now. So all those people, not only did they not invest this year, they're now going to say, we can't deal with this volatility. Like we're going to need now a year or two of sustained pricing before we go in and start putting dollars back in the ground. And, anecdotally, we already see it with the global capex. We see it with the private equity funding going on. It's really apathetic. It's the kinds of deals that are being pitched and people begging for like low 7 figures of money. It just goes to show that the climate is just not right for people to invest. And again, I keep saying this, but as an oil and gas bull, that makes me very happy when the dollars are not going in the ground. As an investment, the only thing that solves this undersupply is more capex and more supply. And if we're not there and we're not even close to there, I feel relatively much more confident in my investments and my trades.
Yeah, and we've had a lot of inflation, I think, these past year or two. How's that inflation impacting the companies themselves? So we've got the SPR that came out and basically brought the price down 70s, 80s, something like that, for a good while. What are the companies doing? Do we have cost inflation coming up where these guys are getting pinched now, or are they just pulling back saying we can't drill? The drilling and the holes are getting too expensive at these prices. What are you seeing there?
Yeah, it's been a trend throughout 2022. I think the number that's often quoted is like a 10 to 15% inflation, and I can guarantee you it's much more than that. It's at least 25% in the case of some smaller producers and private producers, up to 40 to 50% cost inflation year over year. So they're definitely feeling the heat. They've been slowing down some of their development plans because of that. And I think 2023 is going to be another 10, 15, 20, 30% in some cases, a cost inflation on top of that. So there's a big shift, I think, in thinking as well, as the industry has moved from just production growth to now thinking about free cash flow. If the wells don't make sense, then they'll just hang on to them. I mean, there's a limited amount of drilling inventory out there. We don't have an infinite number of wells that people can just drill for the sake of drilling. So I think it's definitely going to have an impact going forward. The internal cost inflation, and it all starts right from the initial inflation. So if the service company itself is seeing inflation on their maintenance, on their labor, on their steel, on their new rigs, etc., they are going to pass some of it to the E&P. And when the E&P now has to suffer this cost inflation, they also have their internal cost inflation from their own labor and their own operating expenses and royalties and everything else. So I think you take all that into account, and the price of oil, I mean, it's just another factor that pushes the price of oil higher, because you need a higher price and a higher sustained price to justify drilling new supply. And a little add-on to that is if you look at some of the hardcore exploration work that's being done, the success rate is just not there that it was even 10, 15, 20 years ago. I mean, we see Equinor in the North Sea. We see some of the plays offshore Namibia and South Africa. Some of the stuff in Suriname is coming up dry. They're not hitting commercial success. There's been two major public failures, one being the Eco-Atlantic Gazania well, and then the other one being the, I believe, the Recon Africa well that they were drilling. Both very highly touted exploratory prospects that came out nowhere close to what people were expecting. So I think we tied back to the fact that it's just getting harder to find the oil. And because it's getting harder to find the oil, you have less exploration success. So there's more of a capex required to get that same reserves and discoveries. And all that is just inflationary to a company's own cost per BOE of future production, or cost per BOE of reserves, finding and development cost. And the higher that goes, the higher that oil prices need to go to justify more and more of that. And it's a big difference. Like, if your success rate on an exploration program falls from 20% to 10%, that means you're spending twice as much money to go and find the same BOEs of oil. So, the number at the low percentage of success rates can start to exponentially rise if you don't hit oil, and if you don't hit massive pools of oil. Like doing an offshore discovery and you find 50 million barrels or 100 million barrels, it's not really enough to justify you putting in an FPSO or some sort of offshore platform. It's you need, call it 500 million barrel discovery or even bigger, and they're just not there yet. We're just not there yet. So watching very closely, but I do expect some of these companies to maybe slow down a bit if they can't find really, really good success, and if some of the governments aren't willing to play ball with what's happening.
Do you think that we're bumping up against production capabilities soon? I mean, since we're seeing these dry holes, we've got some exploration, I'll say unsuccessful exploration. We've got costs that are increasing with respect to exploration. Do you think peak oil's coming soon, or do you think we already hit it? I mean, obviously we won't know unless we're looking backwards, but do you think we're pretty close?
Yeah, so there's a couple concepts here which I would say are interesting to dive deeper into, and one of them is the real notion of like production capability. If we as a world want to produce, call it 100 million barrels per day, easy round number, we need production capacity of somewhere between 102 and 104, maybe a bit lower than that, million barrels per day, because there's always something offline. whether it's maintenance, whether it's operational issues, whether it's weather. We see some of the wells in Wyoming and Montana here recently are now down. So if we want to produce that 100 million, we need that extra spare capacity. It's not really spare capacity, because at no point in the cycle of the world are you going to have 100% of that online. Maybe for a day or two, not more than that. That's just how reality works. Like, this is not a video game where you can run something, all the time at 100% efficiency. So that's one point that I wanted to make. And the other point is, we have the oil. It's not that we don't have the oil. The problem is the oil is stuck in jurisdictions that don't want to produce the oil, or it's too expensive to produce that oil. So as far as hitting production capacity, I think we're there or very close to it. Right now we might be tapping up against it maybe in 6 months or so. And the rest of the projects that are coming online are at least 2, 3, 4, 5 years away. And in the meantime, that's just the lag that there's going to be. So even if the price of oil hits X dollars a barrel, where you say, oh, we should go into Venezuela and fire everything up, or we should go into the oil sands and we should do some projects. Well, too bad. That oil is not going to come online until 2027 or 2028. And really is what strengthens the bull thesis, that once the capex is inputted, there's still a delay on it. So I don't think we're hitting peak oil quite yet, but in the short term, there is no supply that's like readily available for us to bring online. It's all has a lag to it, and that lag might end up getting extended the longer the volatility here goes, and people don't feel confident in the prices in 2027, 2028, and onwards.
So this bull market that's coming up in oil that we're in, right? How does this compare to the previous bull markets? And what do you think this is going to look like going forward? The bull market that we're in. Obviously you said that there was, even if we wanted to increase production capacity, it may be out of a few years, 3, 4, 5 years, whatever it is. What do you think the differences are, and what do you think this looks like coming up in the future? Do you think a recession is going to impact us? Do you think, oil is just going to come right on? What are kind of some of your expectations for this bull market coming up?
Yeah, for sure. So just one comment I want to make on the previous question there. One of the things that you really see as a new supply that can really add on material low decline barrels is the Canadian oil sands. And the issue with the Canadian oil sands that's compounded is that a lot of the oil sands, they started pumping money into projects in like 2010 to 2014, somewhere in there. But the projects never came online until the entire market had gone down. So many of them are still suffering. They never made a single dollar on these projects. Like, some of them are still pre-payout, in that they haven't even recovered their capital cost yet, and we're 6, 7, 8 years past that. So it's not only going to stop supply in the short term, but companies are going to be very gun shy, because they know what happened last time, where the cycle ended up, it took them so long to bring that supply online that the market had cratered by then, and they're going to be very careful of that, doubly so in the Canadian oil sands, which happens to be the only source that, if you put a gun to my head and said, what can add 5 million barrels of low decline production in 10 years, that is literally the only source that can do that. So again, another bullish sign from an overall supply thesis. But to bring it back to your question on where this cycle goes, I think I haven't done that much work on like comparing it to a lot of previous oil cycles, but the one that's most obvious is the 2000 and onward cycle. If we look back, the 2000 to 2014 cycle was actually just one cycle. It wasn't two cycles split in half. The GFC came, it brought oil prices down for a short period of time, a year, 18 months, and we were right back up. And one of the cool exercises that I do with people who argue this fact is just plot the price of WTI from 2000 to 2014. and ignore the dip that happens in '08 and put a scale on the incline of that price, the thing exactly matches up. From 2007 to 2010, the line converges. So that entire cycle was 14 years. Shale killed it for about 6 or 7 years, and now we're back in that supply-driven cycle at a time when demand just does not stop. Demand is continually rising. There was a report just put out this morning that demand is expected to be 104 million barrels by the end of next year. So that's a big jump. We're back on our pre-COVID trend of sorts. And it's the first major thing I see that's well above 100 million barrels per day. So that's what I see from the cycle on an overall basis. As far as recession, yeah, we're going to have recession for sure, because recession is going to be driven by high oil prices and high energy prices. It is going to cause a big problem in global demand growth when you have prices that high. And really, it's the only way to control a runaway oil price is going to be a recession or demand destruction. So at what point do we get there? We don't really know, but there is going to come a time where the price goes up and then it hits this demand destruction, like heavy demand destruction point, at which point the countries that are most unprepared for it, or the ones with the highest, call it GDP to energy sort of ratio, will be the ones that suffer, or the ones that have put the most taxes on the consumption of petroleum will have to come down a bit, and that's going to bring prices into this sort of equilibrium for a little bit. The number that I think we discussed earlier was about $180 crude plus crack spread is where that's shown to be occurring in recent times. So, if crack spreads normalize to $35 to $40, that puts us in a crude price 140 to 150, somewhere in there. So that would be my point where I start questioning, okay, I think it's time to lighten up a bit here, possibly, or you really got to watch, because if that demand destruction occurs very fast, the volatility is going to be insane. Like the spikes on it, $20, $30, $40 in a month, you will see that, especially with low inventories, and you don't have that marginal barrel to absorb some of that volatility. So that's kind of the way I see the cycle playing out. I think investors who are not absolutely convinced on the macro will get shaken out very quickly. And if it doesn't happen very quickly, it's going to happen at some point in the cycle. You will get shaken out before the thing really ramps up. So I always tell people, people start asking me what names should I buy? What's the best way to play this? What's the highest torque? I say, understand the oil macro. Once you have a view on macro, explain your view on macro to me, and I can suggest certain names for you to look into that fit that macro mold. Because if you're just picking random names and they're down 30% in a month and they're up 40% next month, I can tell you a lot of people say they can handle that volatility. Very, very few can actually live through it with a lot of money involved. Going up and down like that. It's not a normal sort of thing that happens in most people's lives. So they're not prepared for it as much as I think people say. And I'm not going to say that I was prepared for the volatility we've seen. Like, for example, last week was a crazy week. The stuff that's happened since June, even overall, sometimes I catch myself wondering, like, am I crazy for investing in this sector? Like, you're some days you're waking up in nights like staring at the ceiling, going like, what is happening? And then some days you're partying like it's 1999 and you're a rock star. So it's gonna be a fun trade, but it's gonna be painful. It's gonna be very profitable, and it's gonna be very, very volatile.
Yeah. So I'm actually riding through. I'm going through that right now. I'm riding through the big moves up and down, up and down. I don't know how I prepared for it. I just do it because I think that oil is going to go much, much higher than where we are today, and I think that's what keeps me in the trade. And I bought pretty early in 2020, and people say it's easier to hold on if you've got gains. I'm like, I don't think so. This is some pretty big. What's that?
the numbers are a lot bigger. So maybe it's
Yes.
in fact harder to hold on to these equities.
I think it is. Yeah, because when you start moving, amounts that you make in a year, normal jobs in a year, you're just blowing through that each day or whatever. You're like, oh my God, this is big. But so we've got inflation. We've got these companies that are drilling dry holes. We've got some, so we've got the cost drilling coming up. We've got people drilling dry holes like some of the major diversified exploration production companies. The question then is, what are some areas or sector, like what are some areas that you think will do incredibly well under this environment? Maybe you can even name a couple companies if you want, that you think has the least amount of risk of drilling dry holes, has a bunch of inventory, or has their inflation controlled, like inflation of their inputs and whatnot. What are some ways to play this thing, or is it just to play the oil price directly? What's your opinions there?
For sure. So I think this is one of the major reasons amongst various others, but this is one of the major reasons why I've really allocated a lot of my capital within Canada. And it doesn't have to be just Canada, but really the thing to focus on is low decline conventional production or oil sands production. Not only do you have very low geologic risk, but you have companies that have already spent the capex, so you don't need them to go out now and do any sort of exploration and delineation. It's already been done. The reservoir models have already been built. They already have the facilities and infrastructure in place to handle this oil, and they have 35, 40, 60 years of reserves. So they could produce at these rates for a long, long time to come. So I think the oil sands, some of the oil sands names would be the ones to target, especially if they have refining exposure. Very, very solid companies, because you get both the crude price and the crack spread exposure, especially in Canada, where some of the crack spreads are routinely $10 to $15 more than the US, like consistently, whether it's low cycle, whether it's mid cycle or up cycle. The crack spreads are just higher in Canada. It's to do with supply demand in localized areas. And then the other way to play this would be low decline conventional, either water floods or polymer floods or CO2 floods, any sort of enhanced oil recovery that's already in place or is imminent. I think are really, really solid plays, because you get really good capex, capital efficiencies on it. You also get a known geologic play. The thing has been drilled for many years, it's been produced for many years, and now they're going and implementing technologies to improve the recovery factor. So the oil is already there. You're not going out drilling somewhere offshore, trying to figure out if there's even a commercial system, let alone if the thing is economically producible. So that's one of the reasons I've been really preferring Canada. I think that's a really good way to play the inflationary thing as well. Less capex is required on these water floods, on the oil sands, on a per BOE basis compared to some of the growth companies or the unconventional shale plays, even some of the conventional producers that haven't fully drilled their acreage yet. So I think those two are the ones that I would really target in the short term. As you probably noticed, my portfolio reflects that sort of positioning. And yeah, I think companies like that will do well, especially if they have a huge undeveloped land package. So if they have something that they can sell on the margins, and they have these extra intangibles, they got land, they got tax pools, they got some sort of royalty breaks, they have maybe some new drills that are doing really well. It just adds on to the already strong base that they've built up. And the trade so far since 2020 has been a relatively momentum trade, where it's the rising tide lifts all boats. But I wouldn't be surprised if you see over the next year, over the next 24 months, absolutely crazy divergences between peers in terms of their relative performance. And the approach of just buying any random company out there, I don't think it's going to work anymore. You really need to focus on what the company is doing, What intangibles do they have? Are they spending a lot of capex? Are they making a lot of operational mistakes? Do they have the right takeaway capacity? Do they have the infrastructure to support their production? And amongst various other factors. And it's I almost feel bad saying this because a lot of people may not be looking to do that much work. They just want to buy, have some exposure to oil. And I think maybe one of the indexes might be the best way to do that, because specific companies in 2022 are red. They're down year to date in a year when WTI averaged 90-ish, maybe 85, 90, somewhere in there, and companies are in the red. I don't think investors would be happy to hear that at the end of 2023, that they bought an oil company, oil averaged $85, $90 a barrel, and they lost money on their investment. So, I think it's going to happen again. So just be very careful where you're investing your dollars going forward.
Here's another thing. Let's say we go to 150, 180 or something like that at some point here, maybe next year, maybe the year after, whenever it is. How much do you think's left in some of these companies? Like, what does that mean for the upside for some of the companies that we're in? I mean, how much upside would that be if it went to 150 to 180 for a lot of these high torque companies?
Excellent question. You're really going on the bull case here. So I think it brings up an important point, which is that oil companies have whether it's the cheapest company out there, whether it's the most highly efficient company out there, it doesn't really matter. There's somewhere between a 20 to 50, in some cases $60 of fixed cost per barrel that it takes to run an oil company. So when the companies are at $80 a barrel, or when the oil price is at $80 a barrel versus $160 a barrel, it's not just that the company's making twice the cash flow. They're making like 5, 6, 7, 10 times the cash flow in some cases. So this is a very important concept for maybe some of the newer investors to wrap their head around. This is not a tech company with zero or very low operating capex or cost. This is not any other type of company that has this linear fashion on cash flows. This is literally, they make no money at $60. At $80, they're making a bit of money. At $100, they're like making a ton of money. At 120, they are swimming in cash. And at 150, like the parties are going to be absolutely wild, like Project X on steroids. So when you start looking at things from that lens, the risk reward on things really changes. So I think the way that I run some of my price targets on the website, if I just run things at $120 oil, some of these companies are on the model looking at 3, 4x on a small to mid cap public company. And then if you start running like 150, 180, things get really out of hand, because that's all extra. Like there's a max on the royalties that people hit at about $100-ish WTI. The operating cost hit a max. Your fixed cost hit sort of this max. Everything after that is just pure profit. So when you're saying 150, 180, some of the companies, I would bet you at 150, every single company is trading at 100% plus free cash flow yield at current prices. So, or at current share prices. And if you say 180, some of them could be 150, 200% free cash flow yields. So just think about that in terms of what can the oil company do with that money? If they're not putting it back in the ground, it opens up the question as to what really happens. Are they going to pay out their entire market cap and dividends in the year? Are they going to go and become this massive acquirer that just goes and buys everything? And the answer is we don't really know yet. Some companies are doing different things. Some are doing buybacks. Some are doing acquisitions. But the money is really made at 120, 130, 140. They're going to be making so much cash. Like they won't even know what to do with this cash. As some of the other energy companies are in this situation right now. I've heard some of the other non-oil and gas companies are maybe already there. And they're struggling to find things to do with the cash.
So, and then the opposite thing, I'm going to talk about the opposite side here. When these guys start making all this cash, and that's my take. It's like a win, because I think that the market balances, the deficits are there for this to happen. What are politics? Can politics and government stop this move? Can they tax that money away? What are the problems there? Is there any problem where they could just come in, tax it all, and we're sitting there with empty bags, holding these shares like, man, this was going to be so good, but governments took it all. What's your opinions there on taxing these things and what could potentially happen from a politics side? I get that question asked a lot.
Sure. One that is on top of mind of a lot of investors when they're looking for the bear case to some of these equities. And I'm going to say that I'm quite surprised at the ease at which some of the European taxes, some of the Colombian taxes have passed. Very, very surprised at that, given that the oil companies hold a lot of clout in terms of the future oil production and the future oil and gas revenues, and therefore corresponding energy security or revenues to the government that are being done. The thing I'll say about North America is North America is a lot different than these places. It is very capitalistic, very, very capitalistic. There's a lot of lobbying power. There's a lot of this like freedom thing going on. For good or bad, that's going to depend on your personal view on things. But I think taxes like this have a lot more opposition in North America, along with the fact that as a percentage of, call it, energy consumption to energy production, the governments are already making way more money off oil and gas companies than a Colombia or than a Europe, where they're consuming a lot, they're not really producing all that much. So if they tax these producers, they actually can somewhat subsidize the consumption. In Canada, for example, they're producing 3-4x what the country consumes. So if the federal government's already making royalties, or the provincial government's making royalties, the federal government's making the corporate taxes, the income taxes, any other, this buyback tax that they recently put in, the capital gains and all this, the governments are already making an outsized amount of revenue and tax inputs into their coffers than a Europe or than a Colombia. And they're going to be very careful not to shoot themselves in the foot, because if they tax something another 10%, yeah, they can get X amount of money. But if that results in a loss of production in the future, you've now killed your golden goose for many, many, many years. And I'm not going to sit here and say governments realize that or that they're smart enough to do these calculations. Mm-hmm. But I believe that this huge windfall that they're already getting without any tax, plus the opposition that they know they're going to face in North America, is just enough to off-put them from doing any sorts of things like this, at least in the near term anyway, while their own consumers are relatively self-protected from these prices. Now, if we find out that the US is exporting oil and LNG, and the natural gas price in the US goes to $15 an MCF, and oil price and gasoline start spiking, it does change things a little bit. But the America and Canada are still relatively self-insured or self-hedged against rising cost of energy because they produce so much of it to begin with. So definitely want to watch there. As far as I've heard some theories about nationalization of the U.S. oil industry and whatnot, and I'll just put it bluntly, I don't think you want the U.S. government be the one who's drilling your oil wells, whether it's America or Canada or whatever. Like, based on the energy policy, some of the statements being made, some of their complete lack of knowledge of what the country produces, how oil works, them nationalizing it and spending more money might result in a loss of production because everything's going to be a dry hole. So just be careful what you wish for, and I think nationalization is just not going to happen. There's way too much lobbying power. There's way too much a freedom and corporate laws to allow any such sort of thing to occur. And even an extra tax, I think, is going to be so heavily pushed back on and just dragged on in the courts, especially with the way the U.S. Congress is now with a split, what do you call it, a split parliament. I think everything's going to be really hard to get passed either way at this point, because the Republicans are not going to want to tax oil companies. It's sort of a given. Although we don't know, because Trump was very anti high oil prices. So we'll see. We'll see how it plays out, but not a worry right now until something concrete hits Congress, where it may be time to start paying attention.
All right, I'm gonna ask you some questions here to see which one you'd prefer. So, starting today, if you had to choose one of these three, what would you choose? Oil, natural gas, or the refiners?
So I definitely not pick the refiners. The refining problem has been relatively solved with the recent additions with the Al Zour and then some of the refiners in China. So definitely punt the refiners, and I would go with oil right now. I think natural gas is just too easily substitutable with coal and even firewood and other things that people are using. Contrary to popular belief as well, the solar and wind capability, anyways, is like rising very, very fast in places like Texas, in places like across North America, some of the places in China. It's really rising very fast. So I don't really want to fight against that, and I just stick with oil, the most transparent fuel, the easiest one to track, and the one that you can't replace. You can't just stuff coal into your big diesel Duramax and start running it. It's not going to work out very well for you.
And then here's another question. Safest producer, producer that has the most torque, and one that we'll say is like you're just swinging for the fence. Like if it may, I mean, maybe torque and swinging for the fence is the same one, either one. The way that I view things is always a risk reward, and I like to fit like in that mid cap range, small mid cap range, where I'm like, okay, I'm good here. They've got production. They can expand. They can do all that. But safest for someone who's like, you know what, I don't want to deal with anything. I just maybe a diversified mining company or whatever it is, whatever your opinion is there. Highest torque, and then maybe the last one will be the best risk reward return that you can think of. Those three. And
you're saying a company for each of them? Is that kind of what you're saying?
Yeah, one company for each. If you had to choose one, what would they be? And I think it's a cool little thing, because a lot of people, they want like a dividend or a safer bet. Maybe another person says, I want to swing for the fence. What's the one with the highest torque? And then the other one where I live is the risk adjusted returns, which are usually buy it at a good price, has really good upside, but also isn't like this small, teeny little company that can just crumble apart. If something happens where one well goes bad and they're just screwed, it's something a little bit larger than that. Right. So what's your opinions there?
Yeah, nice one. I think what I'll do is maybe tie it into the companies that I know the best. That way, yep. I can kind of provide more context if need be. But if you're asking for a safest producer, it's Meg Energy. Like, this is the simplest company to explain. It's one oil sands property. It's not a mining place, so there's no like massive ESG concern here. They've built the plant. They've spent the $4, $5, $6, $7 billion in 2010 to 14. The plant is online. They're hitting production records as of October, about 7 to 10% above nameplate capacity. And they've got 35 years of 1P reserve, which is the proved reserve. And they've got about 55 years of the 2P reserve, so the proved and probable reserve. The one thing about Meg also that people don't realize is that Meg on the Surmont property, which is completely undeveloped, had over 1 billion barrels of 2P reserve that they had credit for. And that got taken away because they never developed the property. Well, there's 1 billion barrels sitting right there next to Conoco and Total's Surmont project. And that'd be pretty interesting if a buyer came in and paid even $1 or $2 for every barrel in the ground. It pays off the entire debt. So, I talked earlier about the undeveloped land packages that some of these companies hold. So a lot of value levers here. They've got massive tax pools. They're relatively insulated to the price of oil. Like, it's a very torquey company still, but they've paid back the majority of their debt. They're buying back 50%, 50% free cash flow back to shareholders through the shareholders return of capital plan. And then you have an added catalyst in that the WCS differential is blown out right now because of the sour pricing across the world. The sour oil pricing across the world is very depressed right now. So as that normalizes with the SPR ending, with OPEC cutting some of their more sour barrels, there's an added bonus in there, and very safe play. I mean, nothing here is really hard to understand. It's one facility, it's one site, it's Christina Lake, it's next to Cenovus, who have delineated this entire thing. Meg is working on some new projects as well, where they can put more enhanced oil recovery, use latest techniques to produce more oil out of the same reservoir. So lots of great things here. Yeah, very stable company. And then as far as looking for a more torquey name, I would pick a high liquids, low decline conventional producer. So there's a couple of them here. There is a Surge Energy, which we've discussed earlier. There is Obsidian Energy. There is IPCO, International Petroleum, run by the Lundins. So companies like this are very favored because they've got these water floods. They have relatively low operating cost and development cost. They just run, and when the prices spike, they're trading so cheap already that all of a sudden your free cash flow jumps from 20% to 50% if the prices go from, call it 85 to 110, just ballpark numbers. So companies like that would be my torque play. They have a bit of financial leverage built in, about, call it 3 to 1 equity to debt ratio, roughly. So bit of financial leverage, not enough that it's going to take the company under, but enough that it juices up the return on the upside. So I would focus on names like that. And then if you're looking at home run names, there are many home run names with relatively low risk in the junior space. So when people think about junior oil and gas companies, their mind immediately jumps to like high risk exploration plays. Like that's not what the junior companies are anymore. They just happen to be a smaller version of the torque companies that I just described. And many people are not willing to go into these names because of illiquidity, because they don't understand the asset. They think it's too concentrated on one thing, whatever. I'm happy to jump into opportunities like that because there's a junior name that's trading at 1/5 the value of a large cap name. They do the exact same thing. They've got the same debt to equity ratio in some cases. They've got similar properties. Why should I pay 5 times more for the large cap name? I'm not in oil and gas to hit singles. I'm in here to hit home runs and grand slams. And if I'm not having to risk on by going down the market cap chain, I will do it every single day of the week. So I think focus on some of the junior names that are low debt, that have some aggressive growth plans. You don't want companies with huge debt loads because it still adds risk, I think, to the investment. So pick something with a lower debt load. They've got some cool properties that they're working over. They're maybe implementing some water floods. They're maybe implementing some CO2 floods. They've got extra properties here and there that they could possibly sell. And pick companies with really good operations, because you don't want companies to make mistakes and lose somehow 20% of their production is down because they didn't fix they weren't ready for a -40 Celsius cold spell. You don't want companies like that. So something with really good management, really good field operations. And I can tell you, there's a handful of companies like this out there with what I would describe as very low risk compared to what people think when I start talking about junior oil and gas companies below 200 million market cap. Yeah, so hope that answers the question. It's kind of a long answer, but
Mhm.
yeah.
And if you were to kind of position across these, would you favor some of the larger high torque ones? Would you try to position more in the junior production companies? Would you grab a couple of energy service companies? How would you kind of want to play this in your opinion?
Yeah, so it's a very subjective question. I think it's going to depend on your portfolio construction, first of all, and how much margin you're running. It's also going to run on how much of your portfolio is actually in energy. Because if you have, for example, 80% of your portfolio diversified into the rest of the broad market, I would start taking shots here at really generating outsized alpha within that 20%. That's really where the upside is of being involved in the oil and gas industry. On the other hand, if your portfolio is 100% energy, it can't be all heavy, high torque names. It just doesn't work because the volatility is going to drive you crazy, and you don't want to be in those sorts of names. Given that there's a way that I've structured my portfolio. I can just share what I've done. I've got about 30-ish% in these large, safe names that anchor my margin position. And then the rest, there's about another 30% that's going to be in relatively safe but high torque equities. And then I've actually upped my junior exposure a lot recently. I've gone from sub 10% to maybe 25, 30-ish% of junior exposure as I see the market changing. So that's how I run my portfolio. And the one thing I find I've been able to do is that, well, there's two things. One is that some of the junior names are actually less volatile than the bigger names, because the bigger names are in the indexes and the funds, and it's what people start dumping when the price of oil drops. So whereas the people in junior names understand the cycle, they're in there because they're comfortable with a more longer term view. So that's one thing. The second thing is sometimes what will happen is the large cap names will stay stable, and then one of the junior companies that you really want to buy will get absolutely slaughtered because a large holder got margin called, or they're just selling for whatever reason. Now you have the optionality to go and sell one of your bigger stable companies and buy more stock in the junior company and really trade around those positions. And so not really a good answer, but it's going to be very subjective as to how active you want to trade, how much margin you're running, what's your broad portfolio positioning, and really how much alpha are you looking to generate? Because if you're looking to generate more alpha, it's going to be more volatile. It just comes with the territory, especially if you then start running margin on top of that, or options. Things can go up or down very, very fast. So I've said this before, it's what makes this oil cycle, to me, very interesting and enjoyable, is that there's a company for everybody. If you want a dividend paying company that's paying 10, 12% dividends, I can give you 3 companies that are doing that. You could not say this in 2010 to 14. There was literally no company doing dividends of that sort. Buybacks, 2010 to 14, they would do nominal buybacks at prices that made no sense, paying 10, 12, 14 times cash flow to buy back shares. Well, now it's completely different. Now there are companies that are doing up to 20% of NCIB plus SIB buybacks. You want a company with high debt, high torque? I can get you that. You want a company that's 100% gas? We can get you that. You want a company 100% oil? We have that. And to add on to that, there's not the same amount of companies out there either. So there's maybe a third to a quarter of the companies that were out there in the last cycle. And really, it allows you to pick companies without getting this FOMO effect, or the capital being so diluted across all these companies that none of them get the right funds flow coming in. So yeah, from that cycle standpoint, I mean, it's a really good way to position your portfolio. You can pick what you want to do, and you can trade in and out of things. The liquidity is relatively good. And yeah, I guess my overarching view is that if I'm going to deal with the volatility, and if I'm going to deal with the risk or the funds flow in oil, I'm looking for home runs. So I position my portfolio that way, but I realize that's not going to work for maybe the majority of people in the oil space, except maybe you and I, and a few handful of others who have gone on this train of 100% plus energy exposure.
Yeah, well, I've got uranium, I've got precious metals, I've got some other stuff too, but I'm very heavily in oil and natural gas. It's my favorite sector. Is there anything that you can think of that can blow this thing up? That can blow the oil market up? Is there anything?
So the biggest risk, call it two risks right now. One would be the paper markets. If the paper markets completely collapsed and there's a lack of liquidity in people that are allowed to even trade WTI, I think that is one of the biggest risks on the actual pricing mechanism standpoint. And you're going to see more and more of this because the big banks and institutions, they all run value at risk models. And when the value at risk on the tail side to the bottom becomes so large, they'll just leave the market. They won't even play any hedging or anything like that. They'll just leave the market flat out, just exit. And you're seeing a lot of this happening recently. Goldman put out a really, really good piece explaining this with graphs that look, the tail end risk on oil going to $40, it may be 1%, but the losses that we're going to take if that happens just skews the model too much. And one could argue that their model is wrong to begin with, but it doesn't matter. That's what the model is. That's the model they're running. Until they change that model, one thing to be very, very careful of. The other thing is supply. If something happens where XYZ company comes out and says, hallelujah, we've discovered how to make enhanced oil recovery from shale, you better be watching how effective this thing is, because there's a lot of oil left in the ground in shale, in conventional, in offshore, in even some of the Saudi Arabian and Middle Eastern fields. There's still a lot of oil left there. And if somebody can figure out even to increase the recovery factor of the world by 1%, you're talking like multi-hundred billions of oil that could potentially be recovered extra. So supply and paper markets. As far as fundamentals go, I'm not worried about demand. I'm not worried about inventories. I'm not worried about politics. I'm not really concerned about taxation. The overall EVs and renewables don't really scare me. It's really paper markets and technology, any sort of major technological revolution. And guess what? When the price of oil is as it's going to be, I think $100 plus, 120 plus, people get quite innovative to produce oil from existing reservoirs and new drills and whatnot. Money talks, and when there's a inherent benefit where you're not only going to make $1 million, you're going to make multi-billion dollars by figuring out a way to produce more oil. People come up with all sorts of crazy ideas that even if one of them works, like a shale, there you go, you've just killed the cycle. But yeah, I don't see anything right now on the horizon that's really obvious. Maybe CO2 flooding might be the one to watch. If companies really like that and they start implementing it on a huge scale, along with multilateral drilling, which hasn't really caught on in the US yet. I'm not sure why, but in Canada, it's been very successful, very, very successful. And not just in one reservoir, but in the Clearwater, in the Manville, in the Bakken, in some of the older reefs and whatnot. Like, people are really trying it a lot of places, and it's cheap compared to shale, which took 10, 12, 14 million dollars for people to go and try shale. This thing costs $1 million Canadian. So people just come up with $1 million and start popping holes everywhere. And if one of them hits, bang on, the game is on. So it's exactly how the Clearwater came about.
And is there any question I'm forgetting to ask you that you think is important for for people to know? I mean, sometimes I miss or skip over something that you might think is important. Is there anything that you think might be important for the viewers to know that I haven't asked?
Sure. Yeah, I think since our last conversation, one of the things that's really changed, in my opinion, and I've been waiting for this for quite a while, is the acceptance of both politicians, governments, and major media agencies that there's a problem. That, okay, right now things are good, but there's a problem. And is it really out there yet? No. But when I see emails getting sent to me by Bloomberg and Reuters and Rystad saying shale well productivity is declining and the demand just won't stop going up, like, I like to see that. I like to see that because part of the reason oil prices are so low is the complete apathy towards this energy shortfall that we have. I mean, I forget who exactly said this, but somebody was talking about you're sleepwalking into the energy crisis. I believe it was either ABS or MBS out of Saudi Arabia, sleepwalking into the energy crisis. That's really what's happening. And until more people are aware of what's happening, I don't think we're going to fix the problem. Not just the underinvestment, but also people believing that oil prices are going to be higher and thus investing in these companies, providing that multiple re-rate. So I was really happy to read, Rystad sending me a chart saying shale productivity hit its peak and it's going down, because we've been out trying to hammer this point and getting extreme pushback from producers, getting extreme pushback from the media, from the generalist investor, even people that know oil a bit. They think shale is like a 500-year reserve of this huge oil everywhere. Like it just doesn't make sense. The data doesn't agree with it. The narrative is completely opposite to what's happening. So, one of the reasons I think oil prices went down for so long in 2015 was that the world just figured, okay, we don't need high oil prices ever again, because if prices go high, well, shale will just add 1 million barrels in 6 months and we've solved the crisis. And some of that thinking still exists today. So I think when a lot of the people who are putting money into investments change their mindset that, look, shale is not the shale that was promised to us. It's going to add an inherent risk premium or a scarcity premium to the price of oil, which is honestly required. It's required to get back in there. We need a instability premium that people have gotten very nonchalant about overall. So, that's one of the things I would watch as an investor. Watch for more of this happening. Watch for the Chinese news coming out about the reopening, stuff about Russian barrels, stuff about world global oil demand, stuff about the shale and the other supply problems that are occurring. I'd love to see more of this out on Reuters, on Bloomberg, on CNBC, on some of the other state medias and whatnot. Because if people don't know there's a crisis coming, they're not only going to be shocked by it, they're going to be completely ill prepared for it. Look what's happening with some of the European natural gas pricing. I mean, this nonchalantness, like, oh, Russia's never going to do this. They're never going to cut off Nord Stream. Putin wouldn't do this and wouldn't do that. Well, he did exactly what you said he wasn't going to do. So, why couldn't Russia cut off 3 million barrels of supply tomorrow? Is it going to happen? Likely not, but there's many factors that can really, really spike the price of oil, and we're not going to be ready for it because the population is apathetic, the governments are apathetic, the investors don't know what's going on, the money managers are unaware. So that's one that I'm really focusing on. I really try and scour the internet for which major agencies have shifted their tone here towards a more bullish oil, not just with the estimates, but with actual data and reasoning why.
Yeah. Have you just curious, have you looked into the ore grade decline of a lot of different minerals and the energy intensity of those declining ore grades? Because if you look out in the future at copper, nickel, I mean, just go across the entire mix of base metals, we've got massive supply gaps out there. And if there's supply gaps out there, they're going to try to fill it with these really low ore grades, which are a lot more energy intensive. And when I look at that, I think future oil demand. Like that's what comes to my mind. I'm like, that's future energy demand, probably future oil demand. And when I look at that and you pair it up with the Strategic Petroleum Reserve that came out, they flooded the markets, held prices down. And then eventually, if China reopens at the same time that they stop the SPRs, at the same time that we hit these, we'll call it base metal inflection points between a surplus to a deficit, and they're all just going to bring in these low ore grades. I mean, couldn't we just see a massive bull spike in oil for some period of time? And it all hits in the mid 2020s, like 2024, 2025, like it's all right there. Do you think there could be a pretty big deficit there where we just super spike this thing to a level that we're like, what the heck? Or do you think it's going to be contained to somewhere you go some certain percent over the cost of the higher production, barrels? You think we'll go like 20% over? Or do you think we could just blow up to the upside? And I know I'm very bullish here. I'm like an extreme bull. That's what keeps me in the trade, is because I think we could go way, way, way to the upside. It won't stay there forever. It'll obviously come back to some higher level. But do you think there's that opportunity there over the next couple, year or two?
Yeah, I think it's dangerous for us to be talking because we might blow up here with the bullishness here between us. So, correct me if I'm wrong here, but I think we were at about 1.2% copper grade 20 years ago. Now we're at 0.6, something like that. Yes. I mean, the reduction is drastic, and it comes down to the point about exploration success rates. It's the same math that applies. The lower the ore grade goes, it's not a linear increase in petroleum, it's an exponential increase in petroleum. So, some of the projects I see, it's like, oh, we got 0.4% copper. I'm like, what? Like, for this to be profitable, oil, and at a higher oil price, your copper price has to be like $5-6 a pound. So it's going to push everything up. You're right. The entire world is just going to have to get used to higher pricing on resources per se. And what makes it even more exciting is that the mines are one of the last things that can be electrified, because the trucks are just so massive. The bulldozers are so huge. The scale on some of these things is indescribable. Like literally, you can't even describe how big these trucks and dozers and equipment is. So, and they consume probably hundreds of gallons of diesel an hour. So when you put all that into the fact that we're trying to build, we're short copper, we're short lithium, we're short cobalt, nickel, tin, manganese, and vanadium, whatever. It's just like, okay, we need all these mines. They're all going to run on diesel, and that's the only way EVs are going to come about. And guess what? These things can't be converted to EVs. So I'm not sure exactly what the impact is. I'd be curious to read more into it. But if the global demand from these mines is increasing from new mines, and then the existing mines are getting less and less ore grade, so now you need more mines, and you need more energy per unit of resource mined. I don't see any reason why that can't be a source of marginal barrel demand, which just starts adding a demand in 2024, 2025, 2026, even if it's 100,000 a year, 200,000 a year. I mean, it could get to those numbers. And you take that over 3 years, well, we don't have 600,000 barrels of oil supply here to give to you. So I'm in total agreement. Like energy, the cost of energy goes into everything, and it's going to be seen in not just the price of oil and gasoline. It's going to be seen in the price of literally everything. So I do agree with your thesis there. I've been tracking the ore grades on copper, not really some of the other ones, but I'm assuming we're sort of running out of the best stuff. And to tie it back into oil, oil is the exact same thing. We've discovered the supergiants, we've produced the supergiants, we've consumed the supergiants, and the oil is gone. Like it's literally gone. So if we now want to produce more oil, it's going to be more expensive. It's going to be smaller pools. It's going to cost more. It's going to have higher geologic risk, and you're going to have to pay somebody a lot of money to go and try and look for these pools, because they themselves know the risks of what they're doing. So one point that is very often ignored, I think, in the whole EV thesis is not only do we not have the materials, but the way you get the materials is extremely energy intensive. Especially when you're talking, what is it, 800 pounds of battery, is it, in an EV, in a regular EV, 800 pounds or 1,000 pounds?
Massive.
Yeah, something crazy. And I didn't even mention graphite, which is, I think, 50% of a battery, and we don't have the graphite to begin with. So yeah, it's looking like it's going to be a, 2000 to 2014, oil prices went up 5x. People just got used to it. That's just how it is. What are you gonna do? Not drive or not live? You're gonna move to like some island with no energy? No. So I'm not gonna say that oil prices can 5x from here. I don't think that's reasonable. But people will be surprised at the range of price that people are willing to pay over a long enough period to get there. And it's just going to become a new normal. Just like people are happily paying 15, 18, 20 cents a kilowatt hour of electricity when they were paying 5, 6, 7, 5 to 10 years ago. I don't hear anybody complaining. Like there's a few people that talk about the carbon tax on it and whatnot, but the actual price of the electricity demand just continues to go up. So it's relatively inelastic, and yeah, it goes into the psychology of things, which I really focus on these days, because I think there's a lot of, it's not just the price you pay, there's a lot of psychology around it. If everybody around you is complaining about the price of gasoline, you're going to start complaining about it. But if people just slowly adapt to it, and you slowly get them warmed up, and it's like, hey, this is what it is. If you don't like it, buy a overpriced expensive EV. Okay, or well, and you buy the EV, and now your electricity bill shoots up. So now what are you going to do? Bike to work? Like you're going to cut other expenses, and you're going to pay for energy. It is the most one of the most polarizing things that people like to argue, but there's no data that supports that over an extended period of time, people can actually cut their energy usage. It's just not shown to be accurate. Like it can get more efficient, but people still consume relatively the same amount of energy, no matter what. So long-winded answer to your very short question there.
Yeah, there was something about efficiency, and you can't ever become more efficient and work your way out of it, because the more efficient it becomes, the more adoptable it is by more people. So it's like like jets, they were not very efficient, but then they got super efficient. Now everyone's flying on airplanes. So the demand went up, even though the efficiency increased. So it's like you can't ever, I say, get more efficient to the point where demand kind of goes down, because just more people adopt whatever that thing is.
Right.
Yeah, but that's all I've got. Oh, go for it.
Yeah, I'm just saying, like, look at TVs, for example, right? Like people used to buy these massive TVs, and now it's like, well, you can buy an 85-inch TV for like $500. So, well, what do you have? Every damn thing has a 85, 95, 100-inch TV everywhere, and maybe they're more efficient TVs than the previous ones, but they're still consuming electricity when half the population has one. So you're right. On the aggregate, a demand is very hard to control, and we've got over 100 years of data to show the oil demand curve, and you could literally put a ruler on it straight as a whistle, and it's right there. And recession, depression, financial crisis, the pandemics, it really doesn't matter. People at the end of the day start consuming more. So yeah, no, great point.
All right. Well, I mean, that's all I've got. I don't know if you have anything else to hit.
No, I think that's good. That's a good little rehash about the major factors right now. It's going to be a very, I think, long and interesting trade. The SPR has really extended out the longevity of this trade. And this trade is not just an investment. This is a way to self-hedge yourself against the cost of everything around you that's going to be rising. And it's also going to be, I think it's going to come with some societal shifts where maybe some of the individuals, the rich get richer and the poor get poorer, sort of thing. So, I think to me, it's just all fascinating. It's not just an investment. I see some of the changes that occur in broad-based society as a whole. 2014 onwards, people were buying Yukon Denali's, they were buying big honking V8s and these like massive tank-looking things. And is that going to shift now more into sedans? Are people going to start going more towards? Are people willing to pay more for renewable electricity as part of the cost of living? Are people going to be traveling as much? Because it seems like the new generation don't really care. They don't care about spending 50% of their paychecks on traveling to a remote island every month, even in some cases. So all these things, I think there's a big shift occurring, and it's just going to be a fascinating trade to watch all that, how it comes back into oil demand, how it comes back into the pricing of oil and everything going forward. So from that standpoint, I think energy investing becomes a lifestyle. And I think for a lot of people who are serious about it, if there's one suggestion I can say, is that energy investing is not something you just buy shares and you leave them there and you come back 5 years later and they've gone up this many X. Like, you will become entrenched in this topic because it's so multifaceted. There's so much to it. There's so much data, information, so many interesting people around it. And I hope to see more people having these conversations, because for far too long, ignorance has been bliss with the energy and the people, the energy that people consume. I don't think that mantra is going to work anymore. You really need to be cognizant of how much energy you're spending, where it's coming from, and how it affects your lifestyle. So I think maybe I'll leave it at that. And thanks again for having me. Always happy to chat oil and gas.
Awesome. Thank you. I appreciate it. And a lot of good information there for everybody to think about. So that's all I've got today, guys. We'll catch you next time. This is Finding Value.